Well, Berkshire's never been very active in commercial real estate. It it works better for taxable investors than it does for corporations taxed the way Berkshire is. So I don't anticipate huge effects on Berkshire, but I do think that the hollowing out of the downtowns in the United States and elsewhere in the world is going to be quite significant and quite unpleasant. I think the country will get through it all right, but as they say, it will often involve a different set of owners.
Yeah, and the buildings don't go away, but
the owners do.
Warren Buffett, one of the most respected and successful investors of our time, has recently raised alarm bells regarding the state of the U.S. real estate market. He warns of an impending major storm that is on the horizon, triggered by a colossal $1.4 trillion in debt. Today, we are going to go over what he meant and why the real estate market might see massive declines in the next couple years. Before we get started, if you'd like to join a stellar investing community, sign up for a premium membership at the link in the description below. Unlock the secrets to formidable investment gains with a premium investing membership. Dive deep into potential multi-baggers, stocks primed to soar by hundreds or even thousands of % over time. With real-time updates on a genuine money diversified portfolio, exclusive market insights, educational content, and a weekly newsletter packed with actionable strategies, it's time you elevated your investment game. Don't miss out. Join the inner circle of informed investors now. Let's get started. This debt-fueled expansion in real estate has come about due to a combination of factors. Over the past few years, there has been an era of historically low interest rates. These low rates have made borrowing cheaper, leading many to take on debt to finance property purchases. This increased demand, spurred on by easy access to credit, has driven property values to soar to unprecedented levels in many parts of the country. But as Buffett points out, this boom may have set the stage for a significant bust. The magnitude of the debt in the real estate sector signifies a kind of financial tsunami. If there's a sudden downturn, it could lead to a wave of defaults, foreclosures, and distressed sales, thereby causing a sharp decline in property values. Buffett's prediction is not just about falling home prices. He anticipates a significant hollowing out of downtown areas. This could be interpreted in several ways. Business closures. If businesses in downtown areas cannot service their debts or experience reduced customer footfall due to a decline in economic activity, they may be forced to shut down. This could lead to vacant commercial properties, resulting in a loss of vibrancy and economic activity in these areas. Residential flight. The decline in property values could lead to homeowners and investors offloading properties, either to cut losses or out of necessity. This mass exodus would lead to vacant homes and apartments, further reducing the desirability of these downtown areas. Reduced development. Developers, wary of the unstable market, may halt or slow down new projects, leading to stalled construction sites and further impacting the aesthetic and economic health of downtown districts. Buffett's warning should be taken seriously. For one, his track record in predicting market downturns, like the 2008 financial crisis, has been notably accurate. Secondly, the sheer size of the debt figure he mentions suggests that even a minor disruption could have outsized consequences for the broader economy. For potential homeowners and investors, this forecast could be a sign to proceed with caution. While it's impossible to time the market perfectly, being aware of potential headwinds can allow for more informed and strategic decision-making. On a broader scale, policymakers and stakeholders in the real estate sector should be vigilant and consider measures to mitigate potential fallout. The decision to invest in real estate is influenced by a myriad of factors, with financing being one of the most crucial elements. The interest rate on a loan can significantly impact the overall profitability of a real estate purchase. The reason for this is straightforward. If two investors buy similar properties for the same price but have different interest rates on their loans, the investor with the higher interest rate will pay more over the lifetime of the loan, reducing their overall returns. Most buyers, especially those making larger real estate investments or those who are not cash rich, will need to finance their property purchase. And as they are borrowing a significant sum, even small fluctuations in the interest rate can translate to sizable differences in monthly payments and the total amount repaid. This, in turn, impacts the profitability of the property, especially if it's an income-producing property like a rental. Higher monthly payments might mean less profit after expenses are deducted. However, banks, as the lending entities, don't just hand out loans based on an applicant's request alone. They need to ascertain that the loan will be repaid and to do that, they assess the risk associated with the loan. One of the primary tools they use to measure this risk, especially in real estate, is the debt service coverage ratio, DSCR. DSCR is a metric that gives banks an insight into the property's ability to generate enough income to cover its debt obligations. Specifically, DSCR is calculated by dividing the property's annual net operating income by its annual debt service. A DSCR of 1 indicates that the property's income is equal to its debt payments, while a DSCR greater than 1 indicates that the property is generating more income than what's required to cover the debt payments. So, why do banks prefer a DSCR of greater than 1.2 times? It's a buffer. A DSCR of exactly 1 leaves no room for unforeseen expenses or vacancies in rental properties. In contrast, a DSCR of 1.2 suggests a 20% cushion above and beyond the debt obligations. This additional cushion reassures lenders that even if the property faces unexpected challenges, there's still a good chance the borrower can cover the loan payments, making the investment less risky from the bank's perspective. Commercial real estate owners are especially vulnerable when their loans, structured with interest rates that reset every 3 to 5 years, face the prospect of rising rates. This vulnerability becomes even more pronounced when external factors, like the surge in remote work, decrease demand for office spaces, leading to reduced rental incomes and higher vacancy rates. An example of an office building owner grappling with both increasing debt payments and diminishing income due to remote work patterns underscores this challenge. They're squeezed from both sides, rising costs and decreasing revenue. Warren Buffett points out another layer of complexity in real estate financing: the widespread use of non-recourse loans. These loans allow buyers to finance properties without personal liability, encouraging them to possibly over-leverage. If circumstances undermine profitability, such as shifts towards remote work or interest rate hikes, owners with substantial debt can quickly find themselves at risk of default. This not only imperils individual property owners, but also poses potential losses for banks, potentially destabilizing the broader real estate market. The real estate market is currently treading on shaky grounds, particularly concerning borrowers who took advantage of historically low rates. These borrowers, enticed by favorable conditions, might have over-leveraged, thinking they could easily manage their mortgage repayments. However, as financial landscapes shift and challenges arise, some find themselves in dire straits, struggling to keep up with their commitments. This puts both real estate operators and lenders in a precarious position. When borrowers can't afford their mortgages, they might have to resort to personal guarantees, putting their assets and future earnings at risk. In extreme cases, this can cascade into bankruptcy, further intensifying the repercussions for all parties involved. Small regional and community banks, integral parts of the financial fabric of many local communities, are facing a looming challenge in the commercial real estate sector. While larger Wall Street entities often garner headlines with their vast portfolios and international operations, it's these smaller banks that have a significant exposure to commercial real estate loans. Their close ties to local businesses mean they have been the primary lenders to these enterprises. Yet as the storm brews in the commercial real estate market, these banks are particularly vulnerable, facing potential significant losses. This situation has a ripple effect. As these community and regional banks grapple with the fallout from troubled real estate loans, their ability to offer credit may diminish. This reduction in lending capacity is concerning for small to medium-sized businesses, which often rely on these banks for their financial needs. With restricted access to credit, these businesses might face hurdles in operational expansion, hindering growth prospects. Reduced growth in turn means fewer hiring opportunities and decreased spending, all of which can contribute to a slowdown in the broader economic landscape. While the real estate market's future remains uncertain, it's clear that its ramifications could resonate deeply within the foundations of local economies. Thank you for joining me today. If you enjoyed the video, consider liking and subscribing to my channel. Until next time.